The American economy added 142,000 jobs in August. Welcome to Market Insight, I'm Ramzan Karmali. Well, that figure was below the expected 160,000 predicted by Reuters poll. The unemployment rate came in at 4.2%. So what does this all mean for the Fed policymakers and whether they cut interest rates later this month? Well, to help answer that and more, I'm joined by Mabrouk Chetouane, Head of Global Market Strategy at Natixis Investment Managers. Mabrouk, thanks so much for joining us. Well, what did you make of today's release of 142,000 jobs added to the American economy?
Well, this number is exactly in line with what we were expecting. So far, what we can say is clearly now the market is not disappointed by the data. The data are confirming that the U.S. economy is slightly slowdowning, so it's not a surprise, and it will confirm the fact that the Fed is about to lower their interest rates by 25 basis points. So this is, the key, the central scenario which is, taking place. The Fed is absolutely, aligned with their scenario that a soft landing is taking place. So the market is probably a bit disappointed because, the indications were about, 160 more job added in the U.S. economy for the month of August. But so far, it's not a disappointing point. So definitely, everything is going on the right way when it comes to the Fed, when it comes to the labor market, declining slightly. There is no collapse in the US economy, so everything is fine, in my opinion.
So a 50 basis point cut now is off the table?
Yeah, definitely. This was, our central scenario. This is, I think, the central scenario of the Fed. And clearly, there is no reason at this stage of the business cycle to see the Fed adding more than 25 basis points. So a jumbo cut is more than unlikely, if I may, simply because there's no need to rush for the Fed. Everything is cooling down. On a steady pattern. So there is no need, to hurry. And if the Fed decided to implement another 50 basis point rate cut, it will be a very bad signal for the market because it means that the market and investors, they are missing something on the U.S. business cycle. So it's not the case. Definitely, we will have, good chances to see these 25 basis point rate cut taking place.
Now, the equity markets, it's fair to say, haven't had a good September so far. I know it's early days. Do you think this might help push them higher going forward?
Well, this is an excellent question, but it's really difficult, to say that these, news will help, the equity market simply because, the markets are already, expecting five Fed cuts by the year end, which is a bit, in my opinion, exaggerated. In your central scenario, we have only two rate cuts by 25 basis points. So this is why I think the market is already, has already priced in these, move from the Fed, and maybe too much, in my opinion. So uh, the Fed will not be another catalyst for the equity market to increase. We need, confirmation that the U.S. economy will not, collapse in 2025, and definitely this could give another leg of increase for the equity market.
Well, let's turn to Europe now, and it's fair to say the latest industrial output data out of Germany was, well, pretty disappointing. So what did you make of the decline in July of 2.4%? It was a lot more than what was expected.
Well, this is not a surprise. When you look at the German data, when you look at the I4 component, the manufacturing sector, these component was already signaling that the sector, the industrial sector, was, in a very bad shape in Germany. And the bad, data that we have, for the second quarter of this year and probably for the third quarter of this year, when it comes to the GDP growth rate, is exactly in line with, the situation of the industrial sector in Germany. It is, clearly in a recession, and there is no reason to see so far the German economy leaving, these, very, weak growth. Simply because it is related to the Chinese story. Chinese data are not good at all, as we can say that. And the forward-looking, indicators that we have are confirming that there is no recovery to expect from China. If this is, the central scenario for China, there is no reason again to see Germany recovering as well or performing well. So the problem with the European growth rate it's, I mean, the dispersion of, I mean, the dispersion that we are attending to when it comes to the core European countries. Spain is doing well. France is, I mean, let's say let's say intermediate situation, and Germany is in a very bad situation again. So this, I mean, dispersion within the growth business cycle situation in Europe is clearly a problem for, I mean, monetary policy.
So, how will this all play out next week when we get the ECB rate decision on Thursday? What do you think policymakers there will do?
Maybe the ECB will prepare the markets for another rate cut, for two other rate cuts, maybe in October and December, or they can decide to add immediately another 25 basis point rate cut. So definitely there is the future for the ECB is to decline, I mean, their interest rates for sure. The timing is extremely important, but adding 25 basis points now or in October doesn't make any difference when it comes to European growth rate or German growth rate.
Mabrouk Chetouane from Natixis, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.